Good afternoon, everyone, and welcome to this conversation with Alan Skrainka, Krilogy's Head of Research and Chief Market Strategist, John McArthur, our Chief Investment Officer, and myself, Kent Skornia, President and CEO. Alan, first, let's just discuss the drop in the stock market. It's like nothing we've seen before. What do you tell people that are really starting to get worried at this point?
Well, Kent, first, it's okay to be worried. We're all concerned. This is a once-in-a-generation experience. But when it comes to investing money, we just can't act on those emotions. We have to follow the plan. I think the investors who come out of this okay are the investors that tap into what I believe are the three most important, powerful principles to manage through a crisis.
And what are those principles?
So the first principle is discipline. And when I say discipline, I'm talking about Navy SEAL level of discipline. A severe market decline is the danger zone when the worst mistakes are often made. And the Navy SEALs are drilled to trust their training and trust their team and to practice self-control when they're faced with dangerous circumstances. And we have to do the same. If you own good quality investments and your portfolio is well diversified, we'll get through this. There is an end to this crisis, but selling after the stock market has dropped 30% has historically almost always been a mistake.
John, how do you attempt to even explain this market? It's it's like something most investors have never seen.
Well, what we know, having been through the last 2 and 3 recessions respectively, is that the market hates uncertainty. And frankly, that's all we have right now. A great deal of uncertainty, no morsel of optimism with respect to potential cure, duration of this virus, fiscal and monetary stimulus impact, or any of the sort. The market is aware of some of the extreme bearish scenarios, such as JP Morgan's second quarter GDP decline of 14% in their estimate, or that the fact that a recession very well may be here already. And so from a contrarian perspective, when you look at such things as bearish sentiment being over 50% in consecutive weeks for the first time since 2009, and you realize that the market is a forward discounting mechanism, as shown in the chart above, the market will typically look out 6 to 9 months in advance and start to price in what's to come. So we've seen that in a very negative way here. We'll eventually see that before economic conditions begin to increase. We'll see the market start to price that in at some point.
This outbreak is moving fast, and the government is shutting down large parts of the economy. How can investors know that we'll come out of this okay?
Well, there is a lot we don't know about the virus. We don't know how long it's going to take to get the virus under control and how long it's going to take for the economy and the markets to recover. But that brings me back to my second principle, which is patience. This slide shows why time in the market is more important than time in the market. It looks at market history going back to 1926. Over 1-year periods of time, the stock market is up 73% of the time. But over 10-year periods of time, the stock market is up 95% of the time. The coronavirus outbreak is unique and serious, but we've had a lot of very serious things happen since 1926, including war and depression. I think the 4 most dangerous words in investing are "this time is different." We will get through this. And thank goodness the government is now shutting down large segments of the economy. Those moves are necessary to slow the spread of the virus. The government is also pouring enormous resources into addressing the healthcare side of the crisis as well as the financial side of the crisis. The world's best pharmaceutical companies are also rapidly deploying resources to develop treatments and vaccines. So I think it's foolish to think this problem will be solved quickly, but I also believe it's foolish to think we can't ultimately defeat the virus and get the economy back on its feet in time.
Alan, that's a good point. I mean, it really, America and the United States have basically just gone all in on whatever resource it takes to fix this, or to at least mitigate this challenge. What do investors do right now? What are you saying to our investors and our clients?
Well, I think as hard as it is, it's important to take a deep breath and attempt to not make emotional decisions. It's really challenging to do. And whether you're contemplating re-risking and increasing equity exposure, or de-risking and getting to the point of not being able to take it, I think it's important to realize that this takes time. As shown on the chart in front of you, this has been the fastest bear market in history. It's only taken 21 days to decline more than 20% in this market. Mm-hmm. Historically speaking, this often takes months and months, if not a year plus, to work itself out. So it's a good opportunity to step back, assess your plan, the big picture, reconsider what your goals are and your time horizon, and make some intelligent decisions and not make anything too impulsive.
Yeah, I think that's a great point. When I'm speaking to our wealth advisors and therefore our clients, spending time with them, it always comes back to your plan. Do you have you set forth a solid wealth plan, and that should have helped you pick a portfolio that gives you proper allocation, and then the allocation helps you pick lasting investments. I guess the question that I hear a lot are we going into a recession? Does the government have the firepower to take, to offset the economic impact of that potential recession? What do you say to that, Alan?
Well, I could say most economists now are in broad agreement that the economy is in a recession. But the average recession-related drop in the stock market historically is about 30%, which we've already seen. So the market already reflects the average recession, the fact that the economy is in recession. And the federal government is now mobilizing its resources to provide support to businesses and workers that are impacted by the crisis. We're still going to experience a serious impact on the economy. I think that's unavoidable. But the resources of the federal government are immense. And unlike the financial crisis, there's very little debate regarding the need to act quickly and to go big. So just like you said, Kent, I think the federal government is all in.
I know history really doesn't repeat itself, but sometimes it rhymes, right? What have we seen in the stock market declines of this magnitude before, and how does history help us sort of mentally frame this up in our minds?
Well, while each challenge, each setback is different, I do think, history doesn't always repeat, but I think the lessons from history can guide us today. This slide shows you the only other periods where the stock market has dropped 30% or more since the Great Depression. As you can see, there's not that many. And I know it seems like just numbers on a page, but I was working in the industry for 5 of those bear markets, and believe me, each one of those was a very scary time, much like today. The next slide shows you that on average, we saw a decline of about 36%, and they lasted on average just over a year. This is shown in days. So the median days, 384. The next slide shows you that what happened next. And as you can see, the average bull market was nearly 10 times the size of the average bear market in percentage terms, and 10 times the length of the average bear market in days. So again, selling after the market has declined is really a mistake.
That you probably just answered this question, but I would say just a small percentage of clients, but a relative number to that will ask me, why not just move to the sidelines until we get the all clear and then jump back into the market? Explain why that could be a mistake.
Well, if you had done that, for example, during the financial crisis 10 years ago, you would have given up 50% of your gain over the next 10 years. As John said, the market can rebound very quickly. And that rebound usually starts when the news is at its worst. This next slide shows what happened to an investor who stayed the course throughout the financial crisis. The top line shows $100,000 grew to nearly $300,000. The dark blue line shows an investor that exited the market, then reinvested after 1 year during the financial crisis. 100,000 grew to just 195,000. And the green line at the bottom shows the investor that went to cash, locked in those losses by selling during the crisis when the news was at its worst, and it's still down almost 50% after 10 years because he never got back in the market. So the lesson from history is clear. Stay calm, stay invested, and stay the course.
Yeah, I also add, based on your slide, stay disciplined, and that extreme discipline is required at this moment. How does an investor think about his or her equity exposure right now?
Well, I think, Kent, it's important to really even compartmentalize an investment portfolio and recognize the amount in equity that you don't have. So if you're closer to retirement or even in retirement, that non-equity exposure can be there to help supplemental spending, any withdrawals that are taking place. And if you can think about the equity exposure from a multi-year perspective, as shown in the chart here, on average, in the 5 biggest market declines since 1929, on average, a year later, the market's up 70%, almost 71%. And if you go out 5 years, you're looking at annual compounded returns of over 23%. So if you can get comfortable, again, assessing your time horizon and treating that equity exposure as multi-year exposure on a going forward basis, then I think that will really help provide some peace of mind. I think the other thing is investors should really attempt to try to look out and visualize what 2022 looks like. You know, perhaps 2021, but in 2022, it's an environment where the virus is gone. We've had a tremendous amount of both fiscal and monetary policy support. And as history has showed us, the U.S. is just very resilient.
And that goes back to, I posted an article on LinkedIn just a few weeks ago about some of the fundamentals that I personally look at when the market goes down of this magnitude. One of them is, do you believe in the United States, and do you believe in the market and the economy over the long run? And I think that's to your point, John. What does 2022 and beyond look like? If you believe in it, it's another argument to stay disciplined on your portfolio allocation. Alan, some of this stuff is, you can see as it can be felt as encouraging, challenging to feel comfortable at the moment. But you spoke earlier about the 3 principles that can help investors manage through this crisis. What was the third?
Well, the third principle is the principle of professional investment management. So our clients aren't going through this alone. Back to the concept of team. The goal of professional investment management is to help investors earn a competitive return while managing risk. And at Krilogy, we don't build portfolios that only work in the best of times. We invest for the long term, and when we make those investments, we assume that we'll have short-term setbacks along the way. Most of our clients have 3 layers of professional management. We have portfolio managers at the mutual fund to help select the right securities. We have an investment team to build and manage and monitor those investments, and an investment committee to oversee that process. And the team also rebalances our clients' portfolios as market conditions change. And most importantly, we have our investment advisors to listen to our clients, to understand our clients' goals, and to work with the investment team to make sure everyone is on the same page.
And I can say that despite this crisis, everyone here at Krilogy is just working really hard and really focused on helping our clients manage through this difficult period. We understand it can be taxing emotionally. A lot of disruption out there, whether it's your work environment, kids at home, containment, self-quarantine type of challenges. But just know that we will continue to provide these updates as much as we can here at Krilogy. We appreciate your confidence in allowing us to be stewards of your wealth. We appreciate you tuning in today, and we'll catch up again soon. Thank you.